Good evening. Please come to our next standard, IFRS 13. IFRS 13 is fair value measurement. First, one small question which is not printed there. In which other standards you have come across today or till today the need to calculate fair values? Many. That's a good answer, but we want some names. At least name 4 standards where we need to calculate fair values, and then it says for calculating fair value refer IFRS 13, IFRS 16, IS 16. Okay, IS 16. Then 40, IS 40, investment property. Okay, then 109, financial instrument. The whole financial instrument is about fair value. Then, and there we had learnt also one line, for fair value measurement, please refer IFRS 13. That's it. Revenue, IFRS 15. Then, so many standard. Okay, that IFRS 5, fair value less cost to sell. So fair value will be calculated here, less cost to sell we will deduct. Then in impairment standard also, value in use or fair value less cost to sell. So when so many standards are requiring you to calculate fair value, why not to have a standard on it, so that there is a standard process of arriving at fair value. Practical application of this chapter is little tough in case if you don't have that asset or that liability which have a quoted market price. Then in that case we have to apply the valuation techniques. Okay. So one more set of professionals will emerge in future, valuers, who will help you to do the fair value calculation so that you can apply all IFRS. Right? You can also try that option. So the objective of the standard is to increase consistency and comparability in fair value measurement. All entities will now follow this standard, so the way they arrive at fair value will be consistent and comparable. And the standard also deal with disclosure requirement. This standard has given 3 level of identification of fair value, which is called hierarchy. Means you have 3 levels. First you start with level 1. If you can find out the fair value at level 1, then you go to level 2 and then go to level 3. Okay. And this way you will be able to calculate the fair value. First priority will be given to the level 1 and the least priority will be given to level 3. So we will discuss what is level 1, level 2, level 3, highest level to the lowest level we have to go. So before we start this chapter, let us first know what is the meaning of fair value. As the name of the chapter itself is fair value measurement. What is the fair value of this pen, if this is the question? So let us find out the fair value of this pen. It is the price. Price and value are different things. Value is what you want to pay. Price is what you actually pay. Price is what you actually end up paying. Okay, so price, and price can be 2 types, entry price and exit price. Entry price means the price at which you buy. Exit price at which you buy an asset. And exit price means the price at which you sell an asset. Now this standard uses which price? After reading this definition you have to guess. Does it use entry price or does it use exit price? Okay. Are you ready for answering this question? the price that would be received to sell an asset. In case of an asset, the price that would be received to sell an asset. And in case of liability, the price that would be paid to transfer a liability. If you sell an asset, you receive the cash, you receive the price. But if you transfer a liability to someone, you take my liability. Why will somebody take my liability? I will have to pay him the price for taking my liability, or the price paid to transfer a liability. In an orderly transaction, what is orderly transaction written below, but again we will discuss in detail. Orderly transaction means the way the transaction is normally conducted in the marketplace is called orderly transaction. If you have to buy share of Infosys Limited, what will you do? You will go to stock exchange on working day, during working hour, place an order. There are large number of buyers, large number of shares. They are well informed, knowledgeable. Prices are available to public. No force on anybody to buy. No force on anybody to sell. The buyer is competent to buy. The seller is competent to sell. Then that transaction of buying and selling is an orderly transaction. Then what is not orderly in this example? Suppose the deal takes place outside the stock exchange. Okay, then that is not an orderly transaction. That transaction is there, but it is not a usual way of doing that business, doing that transaction. And between market participants, this standard looks at fair value not from the entity's point of view. This standard looks at the fair value from the point of view of market participant. How the market participant, means those who are buying and selling in the market, knowledgeable, willing parties, how would they look at the transaction, not how the entity would look at the transaction. Okay. Between market participants at the measurement date, underline measurement date. Fair value is calculated on measurement date. Every day is a new measurement date. Correct or not? That is, if I take a fair value on 31st March 2019, same fair value is not applicable on 31st March 2020. If an asset is purchased 5 years ago, the fair value today is not the amount at which it was purchased. So fair value depends on when are you calculating the fair value. Because as the measurement date will change, the fair value also would change. So therefore this standard talks about fair value with reference to a particular measurement date. Same value will not be applicable on all other dates. For every day the measurement date is different, and therefore the fair values can undergo a change. Now my question you have not answered. Is this price entry price or exit price? Exit price, because it is written price that would be received to sell an asset. So this standard looks at fair value from exit price point of view. The price which you would receive to sell an asset, or the price you will pay to transfer a liability. Now next is the definition of active market. What is an active market? Active market is a market in which transaction for the asset or liability takes place with sufficient frequency and volume to provide pricing information on an ongoing basis. So what is the example you can write here? Share market, BSE, Bombay Stock Exchange, New York Stock Exchange, okay, or even the wholesale markets where you have continuous demand and supply. If there is an active market, that is the best way to identify the fair value. But active market may not be existing for all the assets and liabilities. Okay, That is why this chapter. Now next is, this standard permits you 3 valuation techniques to arrive at fair value. All will come in your definitions, and then later we'll also solve few questions also. What are the 3 valuation techniques permitted by this standard? Cost approach, market approach, income approach. Whichever method which helps you to get the fair value, you can choose, keeping in mind level 1, level 2, level 3 inputs in account. Now I will first quickly define what is cost approach. This is the simplest one, but again you have to apply it carefully. Cost approach is a valuation technique that reflects the amount that would be required currently to replace the service capacity of an asset. So here cost is not the amount that you had paid 5 years ago, probably. Here what amount you will require to pay today to get the same asset which will give you the same set of service, which in more simple terms is called current replacement cost. Current replacement cost is how much cost you have to incur to create an asset, to acquire an asset which will give you the same set of service. So write a note here that this approach is usually used for non-financial assets. This approach is used for non-financial assets. Non-financial assets. Most popular method which this method has suggested is market approach, because this is level 1 input, okay, where you have a market for that product, that asset, that liability. Go to that market, take the value from that market. Or sometimes even if a direct amount is not available, we can take the comparable asset or liability and then we'll make some adjustment and arrive at the value of a given item. That is called market approach. Highly recommended by this standard. A valuation technique that uses price and other relevant information generated by market transactions, like share market, involving identical or comparable assets. If the market for asset A is not there, but asset B is there, B is identical to A. So even that is called market approach. I will take the market value of B. If there is a difference between A and B, we'll make adjustment for that. Example, if I have to value a bond which is not traded in the market, I will take another bond which is traded in the market, find out what is the yield of that bond, is it right? And using that yield, I will calculate the value of another bond which is not traded in the market. Another example, suppose there is a government bond which gives 8% rate of return. I have to value a corporate bond. So what I'll do, I'll take this government bond as a base. Corporate bond is risky, so I will add some 20 or 30 basis point risk premium for that and use it for valuation purpose. So that is called identical or comparable asset, liability, or a group of asset and liability such as business. So we may use market value for a single asset or a single liability. We can use it for a group of asset and a liability, or sometime we can even use it for the business valuation purpose. So starting from small asset, single asset, one can use this method for higher and higher group of assets and liabilities. And what is the third approach they have recommended? Income approach, which is normally what is taught in financial management literature to a large extent, that you sometimes call discounted cash flow technique, DCF. So under this approach, what we do, we estimate the future cash flows or future income or future expense. Is it right? depending upon whether it is asset or liability. If it is liability, expense, income, asset, and will convert into a single current amount by discounting the cash flow. So this method is called income approach or discounted cash flow approach. The fair value measurement is determined on the basis of the value indicated by current market expectation about those future amounts. But this method involves a lot of subjectivity. Why? Two or three assumptions you have to make. Three assumptions here. One, what would be future cash flow? For some asset, it will not be difficult. Like, for example, a bond or a debenture, where the cash flow is predetermined. But for some instrument, it will be difficult. For example, equity share or any other asset where we don't have a contractual cash flow. Second problem with some asset, you don't know for how many years this asset will generate cash flow. Yes or no? So estimating the number of years will also be subjective. And the third subjectivity is the use of discount rate. What discount rate should be used? So in spite of that, one has to see what market participant expects about future income, future cash flow, what is the required rate of return for such type of asset or liability, and then we do the present value calculation. So this is also a very popular method of calculating the fair value income approach, and this may be tested in your exam also. What is entry price? Entry price means the price paid to acquire an asset or price received to assume a liability in an exchange transaction. Now here it is looking at from the buyer's point of view. How much amount you have paid to acquire an asset. In case if you have assumed a liability, how much amount you have received to assume a liability. When we buy an asset, we pay the price. When we assume a liability, we receive the amount. This definition is from buyer's point of view. Entry price is not taken in calculating fair value in this standard. Okay, so that was the role of entry price in this chapter. Now we'll come to exit price. The standard uses exit price for fair value determination. The price that would be received to sell an asset or the price that would be paid to transfer a liability is called exit price. Now you tick mark somewhere below highest and best use. Highest and best use. This is used for valuing a non-financial asset. Highest and highest and best use concept is used for valuation of a non-financial asset. For example, you have a say land. So the standard says you have to see what is the highest and the best use of that land for you, and then accordingly the fair valuation is done. Okay, a land can be used for commercial purpose, residential purpose. Okay, the use of a non-financial asset by market participant that would maximize the value of the asset or the group of asset and liabilities in case of a business within which the asset would be used, and this will be used for calculating fair value of a non-financial asset. So in this standard we have to fair value both the items. You have to do the fair valuation of financial asset and liabilities, and we have to do the fair valuation of non-financial asset also, like land, building or non-financial asset. In case of non-financial asset, we will apply the highest and best use. Okay, if an asset has many uses, which of them is the best use in the given scenario for that market participant? Now you tick mark input. What is input? If you read the standard, sometimes they use such big words. One student called me yesterday, said, "Sir, I don't understand the institute literature at all." because they write in such difficult language. This is not difficult, read slowly. Inputs are assumptions that market participant would use when pricing the asset or liability. It means simply those factors, those variables which you consider in fair valuation. That is input. For example, you have studied bond valuation chapter. So what is the input for that? The coupon that the bond will pay, the redemption value the bond will have, and what is the market discount rate, market expectation. That is input for valuation of that bond. What is the input for valuation of share? The dividend that the share would pay and the required rate of return of the investor. That is input. Any variable which you are going to use for the purpose of fair valuation, including assumptions about risk, such as the risk inherent in a particular valuation technique used to measure the fair value, such as pricing model. Input would also include any risk premium, right? Higher the risk premium. Higher the risk premium, higher is the discount rate used in valuation. That is also input. And it also includes the risk inherent in the input to the valuation technique. Sometimes what input we are using itself is uncertain. Like for example, in discounted cash flow technique, the risk involved is cash flow may be uncertain. Cash flow may not be realized. That is input. And if you don't want to remember so much, just these are those factors which are considered in fair value calculation. Factors used in valuation, simplest version. Inputs can be of two types. Which two types? Observable, not non, unobservable. This is what they have said. Unobservable. Now, what do you mean by observable? Again, you will find it somewhere below. Observable means there is a market value, or there is something which is similar to this which has a market value. So, is there any observable value for this pen? The question has not been answered. How to find the fair value? So, we will see whether there is any market for this. Yes. If this pen is sold as it is, same brand, same model, then that is observable input. This pen may not be sold now. Now this is very old model, but a similar version has come in the market. That is also observable. But if there is no such pen on earth or similar pen, this uniquely created for us, then it is unobservable. And then we have to use our own way to calculate the fair value. So the standard says you have to make maximum use of which input? Observable. Because here you will have more objectivity, less subjectivity, less biasness. But if it is unobservable, the subjectivity would creep in, would come in the calculation. There is no way. If this pen is uniquely designed for me and there is no comparable pen now, so we have to just make an estimate of the fair value today. Inputs will be of three types. They are called level 1, level 2, level 3 inputs. Level 1 is the best. Try to check whether we have level 1 input for calculating fair value. If yes, welcome. Use level 1 input. If no, then go to level 2 inputs. And if this is also not available, then you have to go as a last resort level 3 inputs. Okay. Now the question can be now write note on different levels of input as per IFRS 13. So what are the different levels of input? 1. Level 1 input means quoted price. Infosys share price on National Stock Exchange is 1000 rupees. That is your level 1 input. Because in National Stock Exchange, every day lakhs of shareholders buy and sell shares. Prices are available. There are large number of buyers and sellers. It is a very active market. The moment the market opens at 9 o'clock, lakhs of people have started buying and selling, and prices are continuously available also. So this is level 1 input, quoted price in active market for identical asset or liabilities that an entity can assess at the measurement date. And usually they are not adjusted, but they can be adjusted subject to the requirement of IFRS 13. Okay. What is level 2 input? Level 2 is also observable input. 1 and 2 are observable, but for 1 you have a direct quoted price available. For 2, the direct quoted price may not be available, or even if it is available in a less active market. Okay. Sometimes there is a market for level 2 input also, but the market is not very active. So then it will become level 2 input. Okay. Like there are some shares whose trading may takes place once in 3 months. So that is also traded in the market, but not actively traded. So that will be called input other than quoted price included within level 1, that are observable for the asset and liabilities either directly or indirectly. Another example of level 2 input will be, we don't have identical asset in the market, but we have similar asset in the market. Okay. So we can use the similar asset. For valuation of this given asset or liability. So 2 examples I have given for level 2 input. It is traded but not in an active market. We have a market price available, but then again we have to be careful because it was transacted last time 2 months ago, or there are just few buyers for this item. So then carefully. And then we have similar asset whose market value is available. And the third one is the least desirable input. If you can't find level 1, level 2 input, then we have to go to level 3. These are unobservable input for the asset or liability. Now, how do you value this? Write down, for example, management's expectations. Management expectation. Your project report that you prepare is an unobservable input, that you have just made some guesswork, some projection. Okay. That is called level 3 input, management expectation and projections. Next question is, who are market participants? Because this word market participant was used in the definition of fair value also. Okay, market participants are buyers and sellers in the principal market. One more term will come in your life, principal market. Principal market is also defined somewhere below, but for the timing it means the market with highest volume. Principal market means market with highest volume. If principal market is not available, then you have to see the most advantageous market. What is most advantageous market? The market where if you sell, you will get the highest cash inflow. Is called most advantageous market. So you have market participants are buyers and sellers in either principal market or most advantageous market for the asset and liability, and it should have the following characteristics. First, it should not be related parties. If it is related party, then the price will not be objectively determined. Second, market participant must be knowledgeable. Market party must be knowledgeable. Now, what do you mean by knowledgeable? He should have some basic understanding of what the price should be. Is it right? He should have basic understanding of what the price should be. If I tell you this pen is worth 2 crore rupees, and you say, okay, I am willing to buy, are you knowledgeable? You're not knowledgeable, because you should know that this pen sells for around 1000 rupees in the market. Okay. But somebody is quoting you 2 crore rupees. So it means you are not knowledgeable if you agree to such transactions. So these people who enter into the transaction to buy and sell have a reasonable knowledge as to what should be the price of this item. Buyer cannot fool the seller and seller cannot fool the buyer. So they have a reasonable understanding about the asset or liability and the transaction using all available information, including information that might be obtained through due diligence efforts and that are usual and customary. Okay. So nowadays it's very simple. If somebody quotes you any price, what you should do? Internet. Okay. So in our office, a projector vendor comes, he says this projector is worth 40,000 rupees. I said, okay, give me the model number, company number, and then you search. Immediately you will be able to find out what is the approximate value of this item. Okay. But of course, not every item you can search on Google. And that is where this chapter comes into picture if level 1 input is not there. Second thing is that they should be able to enter into a transaction for asset and liability. That means they should be competent under the law of the land to enter into a transaction. So under the Contract Act, what I remember, they should not be person of unsound mind, then minor, insolvent, they should not act under threat or coercion, undue influence. Okay. So then you are able to enter into a transaction. And next is they are willing to enter into a transaction, not use of force. Go to the bookseller today on the ground floor, put a gun on his head and say, give me this audit book for 200 rupees. He says, no, it is worth 500. You say, this is gun. He gives you for 200 rupees. Will that be a fair value? No. Both the buyer and the seller should be willing parties. Haji? Should not be forced to buy or sell. If there is a force involved in buying and selling, then there is no fair value. So what are the 4 points which is important for a person to be called market participant? They should not be related, knowledgeable, ability to enter into a transaction and willing parties. Then we will take, yes, these are market participant. In the definition of market participant, 2 terms have come: principal market and most advantageous market. So we'll first see what is most advantageous market. Most advantageous market means if you can sell an item in more than one market. This we are talking from asset point of view. Normally when I speak, it's mostly for asset, but it is equally applicable to liabilities. So my point is, suppose you can sell in more than one market. Which is the most advantageous market? Where you will get more cash inflow? Suppose there are 3 markets. Sale value 100 rupees, 110 rupees, 120 rupees. Then what they have asked you to do, for calculating most advantageous market, you have to deduct 2 things. In order to take your product to that market, you have to incur transportation cost also. So if I want to sell this item in Pune, I'll have to pay 100 rupees. I can sell it in Mumbai also for 110 rupees. I can sell it in Delhi also for 120 rupees. But if I sell here, I have some transportation cost to be incurred. Right? For finding out the most advantageous market, we will also deduct the transaction cost. We'll also deduct any transaction cost like brokerage. Okay. And now you find out what is the net amount you will receive. 100 minus 2 minus 1. I think 97. 100 minus 10 minus 10, 100 and again 11. 89. 120 minus 30 minus 20. So which is the most advantageous market? Is the most advantageous market. First to identify most advantageous market. But the answer fair value is not 97. Now there is a catch here. Your fair value will only take into consideration sale value and transportation cost. Sale value and transportation cost. Because in order to take the asset to a respective market, transportation cost will be taken into consideration. But the standard says you will not consider the transaction cost in determination of fair value. So now my fair value for valuation purpose will be 98 rupees. Okay. This formula you will use for identifying the most advantageous market. Once you are able to identify the most advantageous market, then in that case you have to take sale value minus transportation cost. Transport cost is an attribute of the asset. Transport cost is the attribute of the asset. The location of the asset influences the fair value. But brokerage does not influence the fair value. Where the asset is located will not affect the brokerage part. Broker is going to charge you brokerage. Is it right? But the location of an asset is an attribute of an asset and therefore it will be considered. Transaction cost is not an attribute of the asset. Therefore it will not be considered. If I look at this B, it gives me 100 rupees if I only take these two. But this will not be considered in my fair value. This will not be considered. We have to take the most advantageous market in the calculation of fair value. Right. So this was little interesting. For finding market, most advantageous market, I will take transaction cost. But for calculating fair value, we will not take the transaction cost. Now, what is observable input? That means those input for which publicly available information about actual events or transactions are there, and that reflects the assumption that market participant would use when pricing the asset or liability. So in simple terms, observable inputs are available in the marketplace, which one can use in valuation. And now come to orderly transaction. This standard introduces us to a concept called orderly transaction. Orderly, the way it should happen in a normal business. It based on trade custom practices of that business is orderly transaction. A transaction that assumes exposure to the market for a period before the measurement date to allow for marketing activities that are usual and customary for transaction involving such asset and liabilities. So you can just simply say it is the usual and customary way of doing that transaction is orderly transaction. As I have given you one example, if I have to find out the share price of a share which is listed on the stock exchange, what will I do? I will take the price of that share during the trading hours. That is the orderly way of doing the transaction in shares. If I enter into a deal in the boardroom, that is not the orderly way of doing the transaction. Is it right? So it has to be the normal way of doing the transaction depending upon the usual and customary practice in that business. It should not be a forced transaction. That means it should not be a forced liquidation or distress sale. That is not an orderly transaction. Now, one very important term. This standard says fair value will be based on principal market. If principal market is not available, then we'll go to most advantageous market. So what is a principal market? Principal market is a market which has the greatest volume and level of activity for the asset or liability. Infosys says my shares are listed on NASDAQ also. My shares are listed on National Stock Exchange also. I want to take the national NASDAQ price for fair valuation. Can we do that? Say yes or no. No. Why no? Because the greatest volume and level of activity takes place in the National Stock Exchange. Every day in National Stock Exchange, lakhs of shares of Infosys are transacted, but may not be in case of NASDAQ. There nobody may know what is Infosys, or only few people will participate. So that is called principal market. It is not necessary that you go to the principal market to transact, but you have an access to the principal market. You may not actually trade in principal market, but you have access to the principal market in case if you wish to transact. Now the next is what is transaction cost. We will not spend much time on this. Transaction cost means those costs which are resulting directly from and are essential to the transaction, like brokerage, commission, okay, and that would not have been incurred by the entity had the decision to sell the asset or transfer the liability not made. That is transaction cost. What is the role of transaction cost in our problem? Transaction cost is deducted to arrive at. Transaction cost is deducted to arrive at not fair value, the most advantageous market. And what is transport cost? Cost that would be incurred to transport an asset from its current location to the principal or the most advantageous place. Okay. Transport cost is used for both. For identifying most advantageous market and also for calculating the fair value. Okay. That is transport cost. Transportation from the location to principal market is an attribute of the asset. Location is an attribute of the asset. Brokerage is not the attribute of the asset. So therefore in fair value determination, we don't use transaction cost, we use transportation cost. Now the next question is, what is the unit of account? Is it right? Now that depends on IFRS. That depends on IFRS. Whether you want to value an individual asset, whether you want to value an individual liability, or whether you want to value a group of asset or a group of liabilities. For example, you may have to find the fair value of an individual financial instrument, a share, a bond, or a non-financial asset like a building, okay, land, or you may have to find out the fair value of a group of asset. Example, refer IFRS 5. What was there in IFRS 5? Disposal group. And that time also we had used this word fair value less cost to sell of disposal group. Or in some standard, IS 36, you have calculated fair value less cost to sell of an entire cash generating unit, which consists of a group of assets and liabilities. So that is called unit of account. Unit of account means the level at which an asset or a liability is aggregated or disaggregated in an IFRS for recognition purpose. So again here one important thing, if you have to find fair value You have to check unit of account. Are we going to do the fair valuation of individual asset or liability, group of asset or liability, or a cash generating unit, or a business? Is it right? Accordingly, the fair valuation calculations are done. And what is unobservable input? For which market data are not available. That means neither same asset nor similar asset, nor something in the market which can be used as a basis for calculating the fair value of this asset or liability. So that is called unobservable input. So how do we tackle situation of unobservable input that are developed using the best information available about the assumptions that market participant would use when pricing the asset or liability? Okay, how will you value a Kohinoor diamond? Is there any comparable instrument, asset? Sometime may not. Okay, sometimes may not. So in that case, now the problem is you have to find out what market participant would assume in pricing the asset or liability. So you can easily guess this will involve subjectivity. Nothing can be done. Good news, now we have crossed all the definitions. Come to third paragraph. Third paragraph says this IFRS will be applied for fair valuation requirement of all other IFRS, except when there are some specific IFRS dealing with specific fair value calculations. Like for example, in IFRS 2, share-based payment, they have given their own methodology to arrive at fair value of the option. Is it right? Follow that. Or in IS2, valuation of inventory, they have given their own way to arrive at net realizable value, which is close to fair value, but net realizable value is not equal to fair value. Net realizable value looks at the asset from entity's point of view. Fair value looks at the asset from market participants' point of view. So that is the difference. So this standard says for fair value measurement, use exit price notion. Exit price for asset is the amount that you will receive to sell the asset, or the amount you will pay to transfer a liability. And then this standard has given you a fair value hierarchy. Level 1, level 2, level 3 hierarchy. Start from level 1, and if level 1 is not possible, then go to level 2. And if that is also not possible, then you go to level 3. Okay, now we'll see the scope of the standard. This next paragraph says this standard does not apply to following item prescribed in other standards, though they are also measured at fair value. So be careful when the following situations will come, do not apply the standard. Like for example, 1. Share-based payment transaction. Which standard is applicable? IFRS 2. Leasing transaction have also defined fair value. Okay. Then measurement similar to fair value. 17, IS 17 or the new IFRS 16. Then next is, there are some standards which use measurement basis similar to fair value but are not fair value. Like for example, net realizable value under IS2 inventory or IS 36 impairment when you calculate value in use. Then disclosure of plan asset under IS 19 employee benefit. Disclosure for fair value of asset at fair value less cost as per IS 36. And there is one more in IFRS, point number 5. Disclosure by retirement benefit plan investments measured at fair value in accordance with IS 26. Accounting and reporting by retirement benefit plans. There is no parallel standard under Ind AS. The student of Ind AS are wondering there is no such standard. Yes, you are right. So now we are back to our standard. So actually now the standard would start after the definition and scope paragraph. So we have to learn fair value measurement. The standard is only about one thing, fair value measurement. No accounting is involved today. No recognition principle, but only measurement principle. For that we need to read the definition of fair value again. Okay. First, again, let us look at it closely. It is the price that would be received to sell an asset or paid to transfer a liability. Underline the word transfer today. The standard says when you are calculating fair value of a liability, assume the liability will be transferred to other party. Do not assume that the liability will be settled. Okay, there is a difference between transfer and settlement. Transfer means this same liability will continue, but other party will take care of that liability. Settlement means that liability is closed forever. So the liability has to be valued in a transfer transaction, not a settlement transaction. In an orderly transaction between market participant at the measurement date. Okay. Now next is the characteristics of the asset or liability. Characteristics of the asset or liability is taken into consideration by the market participant in determining the fair value of the asset or liability at the measurement date. For example, location and condition of the asset and any restriction on the sale and use of the asset. Now, does restriction on sale and use of the asset is applicable to entity we are talking here or applicable to market participant we are talking here? Market participant, not to the entity. Is it right? So this is a car, private car. In some country, you have to pay a huge amount of money to get the license for a private car. Do you know that? In Singapore. In Singapore, you have to pay a huge amount of money to get the license for a private car. It's very expensive. The government wants that people should travel in your public transport, which is very good. Okay. More and more people buying cars will cause pollution, congestion, traffic jam, other things. So therefore, in such country, the fair value of a car from market participant point of view is very low. For you, it may be very high, but the market participant will think that I have to pay a huge amount of money to get the license of this private car. Right. So therefore, and if suppose this car can be used for commercial purpose, then it has a different fair value. You have a car, what market participant will do with this car? Is he going to use it for private purpose or is he going to use it for commercial purpose? In fact, in some countries like Singapore, they put a tag also in that car or some way that this car is only for private purpose. This car is only for commercial purpose. Like in India also, if you see the number plates, you can make out. These commercial vehicles have a yellow colored number plate. Which they do follow, mostly. Mostly they follow. Some of them may not follow, but mostly they follow. And therefore the value of the car would change. Therefore the value of the car would change. Another example could be you may have a land. For you, there is a restriction on the use of the land. But for the market participant, once he acquires the land, he can use it for commercial purpose or residential purpose. So when he will do the valuation, he will look at from market participant point of view, not entity point of view. There may be some restriction put on entity which may not be on the market participant. Therefore, that affects the value. So the condition and location of the asset and any restriction on the sale and the use of the asset will affect the fair value. If that asset is located at 100 km away from the market where it is sold, then that transaction or the transportation cost because of the distance will be considered. So two parties having same asset but at different location from the market, one may pay 30 rupees, one may pay 100 rupees for transportation, the fair value can be different. Okay. So the condition of the asset, location of the asset, restriction on the sale and use of the asset will affect the fair value. So what I want to communicate here, that one has to look at the asset, not the entity, to determine the fair value. Because for the market participant, the asset is important. What will he do with this asset is to be considered rather than what the entity can do with the asset. Orderly transaction we have discussed. Now next is principal market versus most advantageous market. Where we will go first? Principal market, because the volume is highest. Okay. What if there is no access to the principal market? Then most advantageous market. So suppose my company shares are traded in NASDAQ also, BSE also, NSE also, and the volume is maximum in NASDAQ. So that is principal market. But suppose you are an Indian, you can't trade in NASDAQ market. There is no access, then go to BSE, NSE. Then check which of the two is most advantageous. Fair value measurement assumes a transaction taking place in the principal market for the asset or liability, or in the absence of principal market, the most advantageous market for the asset or liability. So now we will continue tomorrow.